providers. So thank you all for participating in that. Without further ado, I would like to introduce today's moderator, Ryan Udell of White & Williams. Ryan, take it away, sir.
Thank you, Lena. Appreciate it, and welcome everybody. This is the second year that we have been involved with Deal Connect. Last year, which was the inaugural event in Philadelphia anyway, it was live at our offices. Unfortunately, this year it's remote, but it looks like we have a great set of participants, and then we have a fantastic panel today. I'm Ryan Udell, I'm a partner and chair of our corporate security practice at White & Williams. White & Williams is a law firm. We're based in Philadelphia, but we have physical footprint throughout the Northeast United States, from Boston down to Wilmington, Delaware. As a lot of you are, and our offices are still technically closed, so we're all working remotely, and I think we're going to hear a lot about that in how we do deals these days in our panel. I just wanted to again thank Opus Connect for putting this on, and we're looking forward to the day, and we're going to now move towards introducing our panel. So first, I'd like to introduce Jessica Ginsberg. Jessica Ginsberg is Director of Business Development at LFM Capital. And Jessica, I'll turn it over to you to talk a little bit about your firm.
Sure. Thanks, Ryan. As you said, I head up business development efforts for LFM Capital. We are a lower middle market private equity firm based in Nashville, Tennessee. We are focused on manufacturing businesses primarily. We were founded by engineers and former operators who really bring a lot of passion around made in the USA manufacturing. So we look for opportunities where we can add value based on where we've been, who we know, and what we know. We're investing out of our second fund, which is $185 million, and typically look for businesses with EBITDA between 3 and 15 million. Thanks.
Great, thank you. Next, we have Patrick Fleck. Patrick is a principal at Valesco Industries. Patrick, why don't you introduce yourself?
Yeah, thanks, Ryan, and thanks, Opus, for having me again. We've participated in a number of these events over the last few years and really enjoy it. But again, I'm Patrick Fleck. I'm with Valesco Industries. We're based in Dallas. We're a lower middle market SBIC fund. However, what's unique about us is that we are more of an equity focused shop than most SBICs are historically. So we do kind of lead with kind of buyouts in mindset in kind of the traditional sense, but we also put subordinated debt into our own transactions. So we will typically speak for equity and subordinated debt and kind of the entire junior capital piece of the structure. We also focus on businesses that are in the manufacturing, distribution, business services spaces. We try to avoid anything that's commodity related or high tech or software based. Businesses that are 3 to 10 million in EBITDA, with 3 to 7 really being our sweet spot, because that allows us to, again, really kind of control that junior capital piece, and typically going to partner with a founder or family run business that's looking for first institutional capital and a partner to kind of take the company to that next step, rather than buying from other institutionally owned businesses.
Great, thanks, Patrick. And next we have Robert Birdsey. Robert is with Greenpoint Energy, and Robert, I'm sorry, I think it's Greenfront Energy. Apologies, Robert. Why don't you introduce yourself?
Hey, good morning, and thanks, Ryan. Let me just quickly say I grew up in Allentown, Pennsylvania, so I'm happy to be part of a conference focused on Philadelphia, even if it's just virtual. Greenfront Energy Partners is a firm that I co-founded earlier this year. We're investment banking advisory services that focus exclusively on alternative energy. So alternative energy for us means solar, wind, battery storage, renewable natural gas, clean tech, and a host of other smaller options like that. In terms of the services we provide, we will help developers and sponsors of alternative energy projects buy and sell those projects and those assets. We'll help developers source capital, and also kind of a niche service offering that's not directly applicable today, but does give us some differentiated insight is we will represent large investment grade corporates who want to procure renewable energy for their ESG purposes. That's it for me. Thank you.
Great, thanks, Robert. And last but not least, we have Steve Klein from Carriage Hill. Steve, why don't you take it away?
Thanks, Ryan. So Carriage Hill is a New York and DC based buy-side, sell-side M&A firm. We have 23 professionals. Most of our team have owned their own businesses over the years. Our focus is on family and founder-owned businesses. We self-originate those and build relationships with business owners across multiple industries. So we're industry agnostic. Some of those relationships are very long-term. Some are short-term, with the ultimate goal of becoming a trusted advisor for that particular business owner and management team to do something transactional, whether it's to raise capital, to sell the business through a targeted private non-auction process, or to run a buy-side or corporate development program. Our business also we work extensively with certain private equity firms at the platform level and at the portfolio company level to find opportunities to assist them with their growth. That's Carriage Hill. I appreciate the opportunity to participate.
Great, thanks. So again, a nice welcome to our panel. I'm just going to set this up quickly here. And we've got a number of topics, main topics to roll through. But, and this is probably not a surprise to anybody on this call, but if, you know, if you had a pulse during the last couple of quarters, you know that, you know, we were running into Q1 of 2020 and things were looking great. And then obviously, and unfortunately, the pandemic hit. And as a result, you know, Q2 deal volume went down historically, you know, and some metrics show that it reduced in the lower middle market and middle market by up to 90%. You know, it was the lowest level since the Great Recession. You know, the deal flow was, you know, sort of trickled to a halt. And it was, you know, almost like, you know, as they say, essentially in the deal world, you know, you jumped into an ice cold pool and there was that shock to the system. I think gradually, and we'll talk about this in a little bit more detail in a minute, gradually things started to thaw a little bit. But, you know, deal flow is still down significantly in the third quarter, maybe down 40 to 50% year over year, quarter over quarter. And I think a lot of that is because of number of challenges related to COVID, not the least of which is sort of the title of our discussion, which is how do you really get a deal done, and how do you do it in a valuation that makes sense for both a buyer and a seller, you know, in this new world. And so with that, I'm going to kick it off with just talking about the landscape generally. And Steve, I'm going to throw this one to you first, which is what kind of deal flow are you seeing now, and how would you compare that to, you know, even the first quarter?
Thank you. So the deal flow now seems to be more heavily weighted to the buy side, where companies that we're working with, and certainly institutional investors, are looking at ramping back up and approaching the market in a way where there's opportunities. There's been a catalyst for business owners, proprietary family and founder-owned businesses to do something now. Whether that catalyst is COVID, which is the obvious one, or the upcoming election, future potential tax changes, whatever it may be. We've seen a significant uptick in the responsiveness of business owners to our request to at least have a conversation. How that translates into deal flow, I just think there's a greater appetite for especially businesses where they've said to us over the years, next year is going to be better. It's not the right time. I'm going to continue to grow. We're going to do these things and then sell. Well, in some cases, things have been pretty bad, or it's been a shock. And if we can factor in some sort of a reasonable structure, there's a lot more openness to proceeding with transactions.
Great. And Patrick, maybe, given your strategy and focus, or your firm's strategy or focus, dealing with founders and entrepreneurs, family businesses, what have you seen?
Yeah, I mean, I think Steve makes a really good point. We were in a growing and climbing economy where enterprise values were continuing to grow and grow and grow for a number of years. And at least in the spaces that we're looking at, I think this was a shock to the system, and most companies have been okay, whether it was because their industry or business wasn't necessarily materially impacted by COVID. They were deemed essential, so they were able to keep operating, or they were able to take advantage of PPP funding and kind of keep things afloat. But I think what it did is it kind of really registered with everyone to say, look, if I'm, in my late 50s or 60s, do I want to go through another down cycle if there's a recession, a real recession on the other side of this? And then coupled with, the election and potential changes in capital gains, I think Steve's right that a lot of business owners that have built businesses are trying to say, how can I maximize my value now that I've created before it takes a dip and it takes me another 5 to 10 years to build it back to what it was? Do I have the energy to do that? So I think we're seeing the same. We have two opportunities right now under LOI, and we're working towards a third. So I think, Q2 was non-existent. Q3 was all about, hey, we're getting things back up and running and trying to figure out what the total impact of COVID was. And now things are really starting to move, and people are looking to get something done by the end of the year.
Yeah, totally. And in my small world, I've seen the same thing. I've seen a certain uptick in conversation, hiring bankers for folks that who are now saying, I want to get something done, or I am worried about the impact of the election. I don't even know if it's the election per se, or if it's just that someone's going to have to pay this bill at some point, and taxes are going to go up one way or the other. Jessica, let's talk about a little bit about the transaction process. And you mentioned before we got on the call that you guys just closed a deal. So maybe you can sort of talk about what you've noticed in that deal that you closed was different, or what was challenging per se to get it done, just from a process standpoint.
Sure. So I guess I would say overall, all parties involved feel a little bit higher anxiety. Everyone's just a little bit more nervous. Everyone feels like, okay, if we can just see one more month of data to know that the numbers are hanging in there, that'll make us sleep a little better at night. So there's sort of that underlying factor. But I think, typically these processes, as most of us know, you get materials, you submit a bid, and then the next step is to go visit. The deal you mentioned that we closed yesterday was one that launched pre-COVID. There were in-person management meetings were scheduled, but then got pushed to virtual. And so we went through that process and actually got the deal signed up without visiting, without being on site, which I think that there are some firms that would potentially close a deal without a visit, and maybe those are more software focused or something. But for us, we certainly need to feel it, see it, smell it, just put our fingerprints all over it. And so in this case, we got the deal signed up under LOI. We committed to visiting in the first 3 weeks of diligence. So we had people travel, in the first, I think that was about the first half of May. And then, you know, kind of go through diligence with a lot of things that would be on site done virtually, for example, Q of E and things like that. So, you know, and then I think more broadly speaking, we're seeing sort of an extra step in processes right now where that first meeting is virtual. And then, you know, now that there is a bit more willingness to travel, it feels like they're sort of culling down that group that would initially do a management meeting to, you know, maybe 3 parties to actually do an on-site. So it's sort of IOI, Zoom management meeting, refresh your bid, then an on-site meeting, and then, you know, an LOI. So I think, you know, those processes are probably extending, you know, a little bit. So, but, you know, it does feel like, you know, there's certainly capital out there. There are new deals being put into the market. So it feels like all parties are just, you know, adapting.
Yeah, and Steve, as the banker of the group here, I'm going to pick on you again. You know, can you sort of talk about, I know we had a conversation before about, you know, the scope of the process. Can you sort of, you know, maybe walk us through a little bit about how you're seeing processes being done?
Yeah, so our process is different. We're not a traditional investment banking process. We don't run it. We don't run an auction. We don't typically put a sim out and have that full-blown process. But what I would say about it, and maybe this is self-fulfilling, the businesses and the ownership that we work with seems to be gravitating toward that, a tighter, more direct sell-side process where we're reaching directly out to a small handful of buyers, whether they're strategics or financial or both, and managing information closely. So there's not, you know, widespread communication or risk that the word will get out that the company's for sale. And it's almost as if the additional phase, because I agree with Jessica that the process has changed by adding additional phases. And in my opinion, it's an exploratory phase where the business owner doesn't know for sure they want to sell. So the first part of the phase is, well, let's explore what it's going to look like, what the structure is going to look like, the value, the leverage on the business, how much you're going to, you know, all the pieces that are important. From there, I think it's complicated because it's hard to visit. And I agree with Jessica that, you know, depending on the type of business, it can take a lot longer and be stretched out because of the restrictions or concerns about travel.
Right. And Patrick, you know, from your perspective, are you seeing, you know, you guys, you know, still keeping the same mandate, or are you looking sort of more, you know, to that point towards more local, if you will, buy local? I mean, you know, or is that a thing, buy local, or is that just that something people are talking about?
You know, I think there is some validity to it. It's something we certainly talk about in our shop. I think the reason being is that, you know, if it's closer to home, I can more easily manage it. I can get in a car and drive to be on site with management teams. I don't have to worry about travel. It's easier to run my diligence process. But look, at the end of the day, you know, I think there's a lot of capital in the market right now. And at some point, people are going to come out from underneath this rock and say, look, we still have to put money to work. We still have to provide a return to our investors. And so I think people are going to follow a good deal wherever it is. I mean, we're looking at opportunities that are not in our backyard right now, 3 of which, none of them are anywhere close to us geographically. That doesn't mean that we're not putting an extra concerted effort on some of our direct search activities to our own backyard. But, you know, if there's a good opportunity where we feel like there's an ability for us to come in and go about our traditional way of partnering with management and really supercharging growth, putting in process and procedure, getting the right people in the right seats, all that sort of stuff, then, we're still gonna underwrite the deal. It's about what we feel like we're comfortable with from a risk standpoint, not just with the business now, but also with the risks involved with how do you manage once you do close.
Right. Which is always the hardest part, actually, which me as a lawyer, I don't ever get involved in, which is the integration. For another topic, for another day. So Robert, being in the energy space, and which is sort of an area that many of us maybe touch tangentially for, business services or manufacturing, but aren't, squarely within that footprint. Maybe talk a little bit about what your experience has been through COVID and where, the energy industry sits right now.
Sure thing. I think for us, it's a little bit of a different tune. Yes, there has been disruption, but I would not characterize the disruption as significant. For what I do and for capital providers in general within renewable energy, there's a real incumbency edge. So if you kind of came into 2020, having already established yourself, it's much easier than for someone like myself who just started a new business. So I would complain about that. Broader on an industry basis, the cost of debt for operating assets, the spread on that debt is probably up 50 to 100 basis points, but the all-in cost is still very, very attractive. And then just the sort of hurdles that early stage developers of renewable assets need to get through, that's probably been set back a little bit in terms of timing. For instance, you might need to get a local ground use permit from a municipality to build a solar installation. And getting that administrative clerk from the municipality on the phone or a response over email is just harder than it used to be. These are all kind of small issues. And I would say the overall deal flow in terms of volume as well as dollars, I'm sure it went down temporarily in March and April, but it's been at a fairly breakneck pace over the course of the summer, and it's even busier here now in September. So we've been really quite busy. And I think the reason for that is it's a function of two very, very positive fundamental themes at play in our market. One, the cost of renewable energy, wind and solar, is highly competitive, and usually it outcompetes almost all other forms now, including natural gas. 5-10 years ago, the buyer of a renewable electron would have to decide between altruism and profitability. That's no longer the case. And then also, number two, there's just a huge groundswell of end user demand for renewable electricity. And that's driven by states and local municipalities who are making commitments to try to offset some of their carbon footprint. And also a big part of it is corporates as well. So the CEO or CFO of a company who's going on an investor roadshow will go see the portfolio manager and analyst at T. Rowe Price, for instance. And in addition to the PM and the analyst, now there's an ESG analyst from T. Rowe Price who will be in the room shooting tons of questions at the CEO and CFO about their company's commitments to sustainability, et cetera. And so you've seen very, very large Fortune 500 type companies make commitments to offset their carbon footprint by as early as 2025, 2030. And so you have this end user demand, and all of that is not disrupted by the pandemic. And so we've seen lots and lots of deal flow. It's been a pretty healthy year for us.
So Robert is hiring.
Yeah, we just made a hire this morning, actually.
That's fantastic. So I'm gonna throw this out to the group. Maybe I'll lob it to Steve first. So we heard that renewable energy is pretty spicy still. What other industries, verticals, other areas or business types are hot right now?
So I would say as I mentioned earlier, we're industry agnostic. So we work with companies across broad-based industries. Healthcare, depending on where you play in healthcare, is hot. Obviously, we talked earlier about this, and SaaS as well, anything that's recurring. But getting away from that and the specific industries, it really, to me, comes down to, is the business well run? Is the business did it just experience a hiccup or an uptick because of COVID? And how do you adjust for that? So it's what's not attractive are businesses that are in distress, unless you're a distressed buyer. But typically, you don't have, that's not my area of expertise, and I think that's for someone else to speak to. But for the private equity buyers, our clients who are looking for specific deals, business services, certain types of business services, anything related to personal protection, anything related to software, if it's a well-run company. And aside from all of that, it comes down to, if the business just manufactures widgets, but it's a well-run business that manufactures widgets, and it has the core competencies that the buyer and the management team that buyer wants, and it's a willing seller at a fair price, then that's a good deal. And that's also attractive.
Yeah, I would echo that. I mean, what Steve said is exactly right. I think in terms of the types of deals we're seeing, I mean, we obviously lean towards manufacturing and industrials, but have certainly seen our fair share of, services, et cetera. And just based on commentary from other bankers out there, I think software, tech, healthcare have all been really strong, but otherwise seeing a company that just sort of grew right through the last 6 months is really the biggest selling point right now. And I think we'll get into valuations a little bit later, but I think, when you see a business that really wasn't affected, by it at all, especially in an industry where maybe you wouldn't expect that, I think there's actually a valuation premium right now, potentially even above, where businesses were trading kind of pre-COVID.
And I'll just add
All
one
right.
thing that
I'm sorry, go ahead, Patrick.
I completely agree with Jessica and Steve. The only thing I'll add is, you've got your obvious two ends of the spectrum, right? So on one end, you have industries like food, especially that are going into grocery and retail, and even seeing things come back to center aisle. And I think there's going to be a material shift in just consumer dynamics, and that people have been forced to cook at home for 7 months. And are people going to go back to restaurants? Yes, but are they going to go back to the level that they were? Probably going to see more cooking at home. The other end of the spectrum, you have things like hospitality that there's no recovery in sight for that. We don't know when that's going to recover, and that's just a function of what's happened. And those businesses, unfortunately, are all but unsalvageable. But I think where we're seeing a lot of value are in industries that were impacted, but have figured out a way to innovate and adapt and create opportunity out of what this situation has brought upon them. Every single business is going to go through in their life cycle multiple times where you either have to innovate and adapt, or you stay status quo and you start to hit a decline towards failure. And we've seen it even in our own portfolio, where businesses that have said, look, this is our service and this is our product, and we don't know a way to deviate away from that. And then COVID happened, and we've filled almost all the revenue that we've lost through a completely different service. And so I think where you're going to start to see in the M&A activity is businesses that might have been impacted financially, but have proven to say, all right, we've been able to innovate and adapt, and we now have a brand new product line or a brand new service line that's going to be sustainable beyond COVID, and it's going to enhance our value proposition to our customers in the market. I think that's where you're going to start to see a lot of value come in and play in M&A activity.
That's great. We got one question here. And by the way, I think I neglected to mention this earlier, but there is a Q&A button. And if you have questions, feel free to type them in, and I'll ask them at the appropriate time. This is for Robert. We have a question from Bob Maiden, who says, regarding clean energy, are investments in nuclear microreactors a viable future for nuclear energy?
Starting to comment on nuclear technology, for me personally as a philosophy major, I run the risk of blowing my hands off there. It's not something where we see a ton of deal flow, so my domain expertise is not great, but I will say a few things. There have been some very large investment grade, huge incumbent utilities who have been brought to their knees by bad bets on modular nuclear technology. Those were much larger in overall scope than a microreactor, but just bear that in mind, and it sort of cast a dismal spell on nuclear in general. To the extent that the technology risk has been, the technology has been de-risked, then absolutely microreactors would make a lot of sense and could play a pretty significant role in the overall value chain, just because they don't suffer from the intermittency issues that solar and wind do. And they might be more reliable than solar and wind, even when you complement the solar and wind with battery technology. But I just don't have a good feel for whether or not the technology has been de-risked.
Got it. All right, so let's move on to purchase price and valuation. So I'm gonna throw this one back to Patrick. Patrick, so have you seen, in your neck of the woods or otherwise, any changes in multiples? We've talked about changes in deal volume, certainly, but have sellers and buyers come closer, or are the multiples still the same? Where are they?
It's a good question. First, I'll respond, Ryan, that multiples are always higher than I would like them to be, because I'm
of course.
But I think I really do. This goes all the way back to some comments that both Steve and Jessica made, that I think processes have become a little bit more defined, in that it's not about going out to a big, broad auction market and trying to get the highest dollar. I think there are a lot of other considerations that were always present, but now carry a bigger weight. So, have you done it before? Do you have experience, overcoming and presenting solutions for the challenges that my business faces right now? Can you close? Do you have the capital that you need? Can you secure the leverage that's needed for the capital structure you're putting forth? There's a lot of different things at play here that I think carry a little bit more weight, where someone might say, yeah, I maybe could have gotten a turn more, but I'm really confident in this group that I'm selling to, that they're going to be able to not only close the transaction, but help me accomplish the challenges that I want to solve. Now, again, that's for us, in that we're typically looking to partner with a business owner that wants to roll some equity, wants to stay involved, and wants to see their legacy to the next level. It's probably different if you're talking about strategic acquisitions, or a seller that wants to completely go away. But I do think there has been a little bit of wiggle room down on multiples because some of those other considerations are being fulfilled. The other thing is, how much has the business or the industry been impacted by COVID, and what's the outlook going forward, right? If you're investing in a space that a year or two ago looked like, there's no issue, even if we see a recession, it's maybe a 10% decline. Well, now with the amount of unemployment that we have, is there a bigger recession on the other side that's going to affect consumer demand, and how does that impact my business? So I think there's just a lot more information at play, and is keeping multiples lower. The other piece is just leverage multiples. I think people are going to be less likely to, really over equitize. I mean, we've already been over equitizing in a sense compared to 5 years ago. But now with leverage multiples coming down about a half turn, I just don't see the equity groups stepping up for that.
Yeah, makes sense. Jessica, do you want to add anything to that?
So I was just going to say, I agree. I think we are seeing, certainly there's still some sort of traditional broad auction activity going on, but we are certainly seeing more of those, hey, we're reaching out to, 10 groups that we think have an interest here, that have experience here. We're hearing more and more feedback like, you guys really understand what my products do. I really appreciate the fact that you have this operating, experience, that you have expertise there. So I think a lot of business owners just woke up to, what might have been their worst nightmare, just these unprecedented times. And so groups that have that experience, and where, you can really draw a bold line to, this is where I've been and this is where we need to go, I think it really does help. And I think, we're seeing some really high quality businesses trade, I believe, at very similar levels to where, where they traded pre-COVID. We're also seeing a lot more, I guess, flexibility from owners, maybe rationality from owners to say, hey, pre-COVID, I think my business was worth 8 times. Now that this has happened, I understand that there's more risk. Let's meet somewhere below that and share the risk in an earn out to kind of get to my number. And so we have seen a lot more willingness, in structure, flexibility to say, okay, well, maybe that last turn or turn and a half comes in an earn out over the next, year to 2 years or something like that.
Yeah, and I'll throw this over to Steve, but I've seen that again in my experience where there's been a lot more willingness, where it's if it's a banked deal, the bankers and working with their clients, the seller or the target, and being more receptive or open to structures to help really bridge that valuation. It's not necessarily a gap per se. It's just knowing, you really can't account for it properly quite yet. And so therefore you want to share that risk, as you said, Jessica. So Steve, maybe you want to comment on some of the things that you may be seeing that where buyers and sellers are employing in order to get a deal done, where it's not all cash.
Well, so I completely agree with Patrick and Jessica on this. And I think, and buyers always, their sellers, business owners always think their business is worth more than it truly is. I've yet to find one that doesn't. But I think, fair and full price, we're not seeing anything different because typically our clients on the sell side aren't, since we're not running broad-based auctions, have an interest in several things in addition to a good price, a fair and a full price. And that's the case probably with every business owner, seller, other than someone who wants to exit 100%, like Patrick pointed out. But fit, can you close in the terms that you've proposed? How will you account for the COVID impact on my business? Is there a COVID adjustment process? If I have, my top 10 customers, 3 of them, that business has basically dried up and it's starting to come back during the process, am I going to get full credit for that adjustment during that down period? If I'm not, then maybe I wait. If I am, then let's go forward. So to me, it's not as much about multiple as it is about, how you're going to evaluate my business through this challenging period, and underwrite it. And then on the back end of it, is it the right fit? Are you the right partner? Are you going to take care of my people? Are you, if I roll 30%, am I in good hands with you as my boss? That sort of thing.
And, sort of getting a little bit into the nut bolts though, one area that always gets negotiated and, again, as a lawyer, we're sort of on the outside looking in a lot of times, is working capital. And this is sort of the corollary to what I think you just discussed, Steve, which is, am I getting credit for the down period of COVID or the depths of the lockdown? How have you guys seen working capital being accounted for generally, given that you have that anomaly? Are you treating it as an anomaly? Are you, or you're not just using a 12-month average, or are you? And secondly, you have all these governmental programs now out there that, have impacted or have artificially inflated perhaps working capital. So I'll just open that up to the group, whoever wants to take that one, maybe to comment on a little bit of how working capital is going to work, in the new world, or at least in the short term.
I can take it first. I think there's definitely a change. You're still interested in what the historical operations of the business required. So we're actually looking back to pre-COVID levels, and seeing what averages look like there, as well as how things have performed through the last 6-7 months, but also relying really heavily on, what's your backlog and your pipeline look like? What's your forecast look like through the end of the year? And let's make sure that we set a working capital target that will fulfill what you believe business is going to be, as opposed to what it has been, and trying to find some, common marriage between those two. It's definitely more of an art than a science, the way it used to be. And we haven't closed the transaction yet. We're in process. So I think some of those negotiations are still to be had, but that's kind of the way that we're looking at it, is what's right for the business going forward. And tell me about how dependable are you on your forecasts and your backlog that you have in place right now, and how likely is that to close?
Yeah, and Jessica, I mean, have you seen, maybe some of the risk mitigation techniques that we've seen in the past, where you have, maybe you have some banding or collars that maybe share that risk on uncertainty in working capital?
We honestly haven't. The deal we did close was not, it really hasn't been affected too terribly, thankfully, by COVID. So we really haven't gone there with anything yet.
All right.
I can
Steve,
say
you
something to
look
that.
like you want to.
Yeah, just a quick comment. The way we've viewed working capital, in terms of the transaction, not necessarily in terms of what's necessary to run the business post-close, is as a fairness formula. And what does that really mean? It's handled very late in the transaction in most cases. So we're through due diligence. We're basically at the end of documentation, and yes, we have a formula that we've agreed to, but what is it? What's the number? What is the actual working capital adjustment? And you don't even really know that until after you've closed the deal. So the language in the agreement, as you're well aware, Ryan, is, governs, and then the process governs beyond that. But, how do you make that a fairness equation? Because that's really, in my mind, what it is. It's that the seller isn't getting, more cash at close because receivables have converted to cash and they haven't bought inventory, or there's a PPP loan that isn't going to get 100%, paid back. I guess that's not working capital, but it's debt. Or there's been deferred payroll taxes. I mean, how do you account for all those things in a working capital formula? And it shouldn't be different. It's just encompasses more things. Right.
It makes something that, like you said, usually happens at the last minute now that much more complicated. But I think I agree with you. I think that both sides have to look at it equitably when they go into it and say, it's a little hazy. So we need to figure out something that helps us share that potential risk. So let's turn our attention then to credit, because obviously, and I think, it may have been Patrick that said it earlier, a key component of valuation is, how much leverage you're going to be able to get in order to do the deal. And obviously, you can always put more equity in, but as we all know, that's not something that, private equity funds love to do. And so, let's talk about, where the credit markets are today. And maybe I'll turn that back over to Patrick to comment a little bit further on the credit markets and what he's seeing. And again, you're an SBIC fund. I know you do more buyout deals, but maybe some of your colleagues and compatriot funds where they're lending into deals, like what are they seeing? Are they seeing a little bit more openness in the credit markets? Are they still pretty closed? Where are we today?
Yeah, so I'll speak a little bit first about where I see senior, and given that we have the majority of our investor base as small regional and kind of super regional banks, we've always been a little bit more conservative with our capital structures on the leverage side of things. It used to be, well, we want funded debt, funded senior debt, and funded total debt to be inside the 3x4 box, right? 3 times senior and 4 times total. Well, then, over the last year to 18 months, everyone started getting a little skittish and saying, well, we've been in this growth environment for so long, there could be a recession coming up. Now let's scale it back. Now we want committed senior to be inside 3 times and committed total to be inside 4 times. And now what we're seeing is that, I think you've seen that scale back by another half turn or so. And some of the deals that we're underwriting, we're looking somewhere between 2 and 2.5 times of senior funded debt, and well inside of 3 times on a committed basis if you add in an undrawn revolver. And so I think a lot of banks were able to generate a lot of business with fee income, et cetera, with PPP loan program without increasing additional overhead. And everyone's worried about how their portfolio is going to perform if there's another wave of shutdowns and there's no additional funding. So what will that do to their credit portfolios? And so no one is really excited about putting a lot of leverage on a new transaction right now with this much uncertainty. So we've been trying to take a really conservative approach. On the sub debt side, we've typically used it more as an additional security investment from our fund. And so when we're the control equity, we're typically going to price, around 14%, and we're going to do somewhere around 1 to 1.25 turns of leverage. I do think you're probably going to start seeing, just because of what banks are comfortable with, you're going to start seeing people scale back where, especially in the independent sponsor model, where people were trying to put, 2 turns of mezz on top of some senior debt. I think that you're going to start to see that scale back. I don't know if I can speak much to the non-bank lender market just because we don't utilize them near as much. But Jessica might have thoughts there. But that's kind of what we're seeing.
Yeah, Jessica, maybe I'll throw that over to you to answer that one, and maybe also just sort of give us a general thoughts on pricing that you're seeing, whether pricing has changed as well.
Yeah, so I would say, I think overall, definitely echoing what Patrick said, we're seeing total leverage down probably half a turn to a turn, depending on long-term financial performance, depending on COVID performance, et cetera. I would say though, the credit markets, they're open, I think earlier days through COVID, just talking to a lot of bankers who said, yeah, we're pushing pause on all of our deals because there's no financing out there. We have found we've sort of approached the lending markets in 2 instances. And in both cases, we've gotten, more than enough interest, and, are in one case have closed, in another case are moving towards a close. So we certainly feel confident that the capital's out there when we need it. On pricing, I don't have a lot of specificity there. I'm just not as close to those processes at our firm. The other thing I would add is that seller financing, I think, is another lever that we have used even pre-COVID. And I think, may become more common just to kind of fill that gap when, you think there's going to be, a quarter, half a turn more of senior and it's just not there. We've had some success with that.
Yeah, and that's certainly cheaper than mezz. So we have a question. We have one question, and I think we're running late on time here. We have a couple minutes left in the program. I'm going to ask this question, and then we can wrap up unless there's any other questions. From Carl Wohler, how are you managing PPP loans and the forgiveness process in companies moving to a sale or recap? Does anybody want to take a stab at that one?
I'll take a stab. I don't really know. This is a guess. It seems that we would recommend that it's reserved for as, an escrow until there's resolution of the, and once there's resolution and if it's forgiven, that escrow is released back to the seller.
Yeah, I'll echo that and take it one step further from the buy side is that we would prefer that the process begin well ahead of close in terms of getting approval from the SBA for change of control. And if that process is in place and, all of the data and financials suggest that it would be forgiven, then yes, I think we would reserve in the form of an escrow. But I think it would be very tough for us to close with just the basis of the seller saying, well, we've calculated and it's all going to be forgiven and we're just waiting to start that process. We would really need it to be off the balance sheet. And we also are looking at EBITDA on an adjusted basis to make sure that EBITDA is not inflated by other income coming in from PPP funds. Right.
And we've seen that, by the way, in some deals that we've closed, we've used escrow. I think to your point, you can do an asset deal too, which mitigates the risk a little bit. But also the last thing is there actually is, there is some insurance. There's PPP insurance that you can also buy, much like reps and warranty insurance. Not that cheap though. I think that's it, Lena. I think we've run out of time, it looks like, because I'm getting the full screen. So I'm going to, I guess, turn it back to you.
Yeah.
And thank you, everybody, for participating, my panelists and the audience. I know there was a question or two that we didn't get to answer, but we can try to follow up after.
Yeah, thank you so much, Ryan, and thank you to all of our panelists and, of course, our audience. We apologize for those technical difficulties that we had earlier on. These things happen with the new virtual world, but we appreciate your participation. If you are participating in the Deal Connect one-on-one meetings, you'll want to log out of this link now and log into the separate link that my colleague Terrence previously circulated. If you have any questions, feel free to reach out to the team. We have another webinar coming up on the 24th and another one on the 1st and many after that, so stay tuned. We'll be in touch, but until then, stay safe, everyone, and we'll talk soon. Thanks, everyone.
Thanks a lot.